We've got James Heath here from Money For You Mortgages. Your nice shirt, and I know you're wearing your pajama pants.
Stop it, Billy.
I use him. He's our favourite. He's great at what he does, and today I just wanted to get him online to have a chat about what's happening with the banks, what's happening with the mortgages.
A lot of clients are hurting out there with their financial situation, sort of talking them through their specific situation and providing the best advice they can and providing them some short and medium term solutions. There's 3 or 4 different solutions out there for clients. If, let's say, you're an investor and your tenant has left. I had a client that's tenant left on the 30th of March. We've offered to get them what's called a mortgage deferral. So the options effectively are extending your loan term, which means you're still paying money on your mortgage, but the loan term might have gone from, say, a 20-year mortgage term to a 30-year mortgage term. And what that means is you're paying less per week. Okay? Or you might move your payments to interest only. Now what that means is that you're still servicing your loan, but you're only paying the interest component, because normally when you pay money on your mortgage, you're paying interest and principal. So which means you're still making payments on your loan, so your loan balance doesn't increase. It stays exactly where it is right now. And the third big option is the mortgage holiday. Now the mortgage holiday might sound great, however, when you drill down to it, it's all about you don't pay any money at all at this point in time, and that's the advice that we gave this particular client. It's really relying upon that rental income, and that mortgage holiday, basically the interest component of that loan adds to their mortgage. So if they had a $200,000 mortgage today, next week the interest will have added on to that mortgage, and they'll be charged interest on top of that new amount. So after 6 months, that mortgage value might be now, say, $210,000. What it's done for them, though, is it's actually alleviated their cash flow position because they're not paying anything on that mortgage in the meantime. But longer term, they'll be paying interest on interest, which is compounding. Okay. In 6 months' time, they might have the ability to fast track that mortgage again once things hopefully settle down, and they might get back to a bit of a normal position. So 3 different options there: extending your loan term, moving to, say, interest only, or taking a mortgage holiday. Each has their merits and each has their disadvantages.
For the people that want to either extend their loan term or go to interest only or go on a mortgage holiday, how will this affect their credit rating with the bank? I'm assuming...
A very good question. In the past, before COVID-19, it would have actually had a major impact on their credit file because it would have been lodged on their credit file. Credit agencies have agreed that if people are taking a deferment or an interest only or a mortgage extension, that won't affect their credit file at all, because this is unprecedented and this is actually beyond the customer's control. This will not affect their credit file at all.
Right. Well, how does our audience find you? How do they get in contact with you? If they want a mortgage, if they want to refinance, if they're looking at their options for a mortgage holiday, extend their loan period, and they need help with that, I'm suggesting to them that they see you. How do they do that?
So email me, James at moneyforyou.co.nz. Good boy. Thanks,
Thank you, everyone. Have a good afternoon. Bye-bye.
Bye now.